So today's video is all about something which is very topical right now, QE2, or quantitative easing 2. A fairly ghastly expression, and what we're going to talk about today is what it means, why it's being done, and will it work? Okay, so what is quantitative easing, to give it its full title? The reason it's called 2 is because it's been tried before. So this isn't the first time that the Americans, who are initiating this, have tried quantitative easing. And essentially, what they're trying to achieve is very simple. The American government, just like the British government and other governments around the world, is worried that the American economy is stalling. It's not growing fast enough. So what can we do about it? And the answer, they think, is buy lots of stuff and get it moving again. And that's what quantitative easing is all about. In a nutshell, it's governments buying stuff and doing things in order to try and stimulate growth. And that's worth bearing in mind. Okay, so what's the principle? What's going wrong? What is the problem they're trying to solve with the second round of quantitative easing, or QE2? In a nutshell, money is vital to the modern economy. We don't barter anymore. I don't swap my accountancy services for a bit of roof tiling or 3 sheep. Money is used to price goods and services. So as goods and services flow around an economy, so does money. And some economists say, well, if that's true, then money is one way of measuring growth. If you understand what's happening to money in the economy, you understand how quickly or slowly an economy is growing. So, who are the key players in the money side of an economy? Well, one of them is a central bank. In the UK, we have our Bank of England. In the US, slightly different system, but similar principle, the Federal Reserve. So the government's banker in each case. So when we say the government does this, the government does that, what we mean actually is the Fed in America or the Bank of England in the UK. Then there are other banks. There are commercial banks, retail banks, investment banks. Let's just put 2 in. So, names such as Barclays, HSBC, Goldman Sachs, Morgan Stanley, all those good names. Then there are people like you and me. We form what's called the retail side of the market, and there are companies. And in a healthy economy, money whizzes round between all these different institutions. So, there are transactions between central banks and commercial banks. There are more transactions between commercial banks. They lend to each other, they borrow from each other. They also, hopefully, lend money to you, so you can buy a house, for example, or pay for your next car. They offer savings accounts, so you've got somewhere to deposit money safely. You spend some of the money you borrow buying goods and services from firms. They then reinvest it in the banking system, let's say, and so on and so forth. So you can have arrows flying everywhere if you want, but the point is money is flowing around the system. And economists believe when money flows freely, you have economic growth. It's evidence of economic growth. The two are directly linked. So, what's QE2 for? It solves a problem. Blockages. What happens, for example, when people suddenly get very nervous and stop borrowing money from banks? Suddenly people are worried about their jobs. People are thinking, I don't want to borrow lots of money and spend it on a car. I don't want to buy a car at all. I'm going to save it, or I'm going to pay down my mortgage. Or what happens when banks suddenly stop lending to each other? We had that in the first wave of the credit crunch. The interbank lending rates rocketed. Again, the system was blocked. Banks were thinking, I don't want to lend to Tim Bennett. In fact, I don't even want to lend to another bank. I'm that nervous about not getting my money back. Or what happens when you stop giving your money to firms? You don't want to buy anything from them. So they in turn stop spending money themselves. They stop investing in new plant and machinery and so on. And the answer is simple. The economy contracts. And the reason is basically this. Economists say that GDP, that's economists speak, gross domestic product for wealth, if you like, can be expressed as how much money there is around times the speed it's whizzing round the economy. So economists say, basically, if there's lots of money and it's whizzing around the economy quickly, the whole thing will grow. Great. So what's the problem? The problem is when people get nervous and firms get nervous and they stop borrowing and they stop investing and they stop spending, velocity slows right down. In other words, people hoard money, they don't spend it, it doesn't move. I, for example, take my salary every month and I dump it in a savings account, and the next month in another savings account, and so on. The money is going simply into my savings account. So when that drops, and it has done sharply recently, economists say the solution, QE2, is this: pump more liquidity into the system. Okay, to get growth back on track, let's inject more money into the economy. And that's the basis of this solution called QE2. It's about unblocking the system. It's supposedly about restoring confidence. That's firms' confidence and confidence of individuals to spend by increasing the supply. So, how does this work? What solutions do central banks have to potentially get the economy moving? And the answer is they've got two. In QE2 this week, which could involve figures of $500 billion to $1 trillion US, we're talking big amounts here, involves the second one of the two. So, what have they tried? What hasn't worked so far, which explains why they're doing this all of a sudden again? So, as a central bank, so imagine I'm the Federal Reserve or I'm the Bank of England, I'm thinking, right, I've got to get the economy moving, I've got to get money available, got to get it moving around the economy. How am I going to do it? They don't have that many weapons available. I mean, after all, they can't force me to spend my salary on anything. They can't force Tesco to build more stores. So they can't really even force banks to lend money, although the nationalised ones owned by the government can sort of be forced to. So basically, what can they do? The answer is they haven't got that many weapons available. As a central bank, as the Federal Reserve, I have two weapons. One, I can drop or lower interest rates. And boy, have they tried that one. The Bank of England base rate crashed after the credit crunch. The Federal Reserve massively reduced its central bank interest rate. Why is that a good idea? Because, from the previous diagram, that influences the rate at which banks lend to each other, and that in turn influences the rate at which they lend to you and me and companies. So, in an economic nutshell, drop the central bank rate, and through a chain of events called open market operations, essentially that makes my mortgage a bit cheaper, and it also makes personal loans and company loans cheaper. So, that sounds like a great move. In other words, flood the market with extra liquidity, as it's called, and let people crack on with spending all this new cheap money. Pity then it hasn't worked as well as they thought. And the reason it hasn't worked is because you can throw as much money at people as you like at a cheap rate, but you cannot force them to spend it. If I choose to either pay down my mortgage or build up my rainy day fund in case I get fired, cheap money makes no difference. And there's the problem. Or take banks. Banks are quite clever. So imagine you're a bank and you're thinking, this is great. The Federal Reserve is prepared to lend me money at close to 0%. Great. I'll take that, thank you very much, and I'll invest it in anything that pays more than 0%. So I'll simply buy nice, safe government IOUs that pay around 2%. That's still a straight 2% profit. Or maybe I'll speculate on higher risk assets. In other words, I won't take the money and lend it out to individuals and businesses. I'll take the money and take a punt with it. So, lower interest rates haven't done what central banks hope they might do. So, let's try buying assets. Okay, and we could be talking about $500 billion to $1 trillion worth, the numbers due to be confirmed. But let's buy assets. Buy what assets? What can they buy? It's not going to be cars and fridges. It's going to be bonds. And there's a big question over what type of bond you buy. So, what the Federal Reserve would like to do is buy bonds. Some of these will include government bonds. Some of them may be mortgage-backed securities. In other words, buy up bonds. The idea is that if they create the money that's needed to buy the bonds, that money will find its way into the pockets or onto the balance sheets of commercial banks. Those banks will then feel more confident to lend. And the fact that the Federal Reserve is buying bonds should push the price of those bonds up and the yields down. That will discourage the kind of speculative activity in Treasury IOUs that I just talked about, and maybe shore up the balance sheets of the banks that carry other similar bonds. So the idea is to create a ripple effect. But will it work? Now, there are reasons to worry. First of all, as I said, the Federal Reserve or the Bank of England cannot force me to spend money simply by throwing more cheap money at me. And that's true of banks, companies and individuals. And there are big risks. Number one, if you create electronically more US dollars to fund all these asset purchases, now it's done electronically, there's no printing press, just as when I collect my salary, I don't turn up with a wheelbarrow and say fill it up. I accept an electronic transfer into my bank account. I then spend it electronically on a credit card. I don't do everything in cash. Well, it's the same for central banks. So they'll create a lot of cash electronically, use it to buy assets. By creating a lot of US dollars, the value of the dollar will drop. Problem for the Chinese, amongst others. They own a lot of dollar-denominated assets. They could get upset, there is talk of currency wars, if the value of the US dollar is trashed too much more. Next, speculation, commodity prices. A lot of this money, if it's not going to companies so they can invest, and it's not going to you and me, where is it going? And the answer is some of it's flooding into commodities. Take a look at what's happened to the prices of some key commodities. Even before QE2, just after QE1, prices have been rocketing. Gold, for example, is sitting around $1,350 an ounce. That's way, way, way above the kind of $250 to $300 an ounce when Gordon Brown sold off half the UK's reserves way back. So lots of commodities are finding they're suddenly being boosted by a wave of new dollars, new money. And that's a problem because it can trigger inflation. And here's the catch-22 for the central bank. If, by buying lots of, say, government bonds, they are trying to squash the yield and maybe even discourage some of the speculative, easy money to be made in that part of the market. The problem is, if investors think that all this new money is going to trigger inflation, maybe via the commodities market, ironically, it may have the reverse effect of the one they intend. Because inflation tends to widen yields on bonds, not depress it. So, there are some who would say QE2 won't have its intended effect and may have some fairly unpleasant side effects.